So one of the ways in which we can assess the financial health of a company is by calculating something called liquidity ratios. Now, what are these? Take a look at the balance sheet. What do you see? Well, you have assets, liabilities, and equity. But more fundamentally, assets are all the places where the cash has gone. This is where the cash has been invested. Short-term assets, long-term assets. Right-hand side is liabilities and equity. These are sources of funding. This is where you got the money to fund those assets with, right? Some of the money came in the form of current liabilities, short-term debt, some in the form of long-term debt, and then some in the form of shareholders' equity. Now, liquidity ratios are basically trying to assess one thing and one thing only, which is how well is a company able to meet its short-term obligations or short-term debts, right? So current liabilities. So for example, if you have accounts payable from your suppliers, suppliers lent you some raw material and said, hey, we'll collect from you 30 days later. Well, it is a liability. It's coming due in 1 year or less, in this case, 30 days. So some cash will leave your business, will need to leave your business, right? In a short amount of time. So that's a liability. Notes payables, same thing. It's a short-term debt. You have to pay it in 1 year or less. Sometimes you can even have something called the current portion of long-term debt here, meaning that let's suppose you have a 10-year loan, but there's a payment on that loan which is coming due in this particular year and the next year. You can have that as a current liability as well, because it's going to be leaving your business in less than a year. So the question is, how well are you prepared as a business to meet those short-term obligations? You know that you're going to make these payments in less than a year. The question is, will you have enough funds to meet those cash outflows? So the way you reflect on that is by saying, hey, you know what? On our asset side, we may have something. Now, generally, our fixed assets are those that are going to be generating cash flow over the long term. So we may not be getting a lot of money from these in the short term, but our current assets, these by very definition are those which are going to get converted into cash rather quickly, specifically in a year or less. So for example, cash and cash equivalents, right? Practically cash. Accounts receivable. Our customers owe us some money, and in less than a year, maybe 15, 20 days, they're going to pay us. So we'll have some cash to maybe meet those short-term obligations that are coming up. Inventory, same idea, right? Inventory is going to translate into a sale. Sale is eventually going to translate into some cash, so we'll have some cash to meet those short-term obligations. My point is that liquidity then, as you can see from this, is very specific to current liabilities, short-term obligations, and how well we're prepared on the asset side, specifically on the current asset side, right? So all of a sudden, the rest of the balance sheet doesn't even matter. With respect to liquidity ratios, you're looking at current assets in relation to current liabilities. That is it. And in fact, that's the first ratio that you can calculate. It's called the current ratio. You know why it's called the current ratio? Current assets, current liabilities. So for 2019, your total current assets are 642. So you'll say 642 divided by current liabilities of 543. And if you do this calculation, this comes out to 1.18 times. Why times? This is our unit of measurement, times. Why? Why times? Because it says that for every $1 that we're going to pay in the short term, we have 1.18 times that in the short term to cover it, right? So we can cover that $1 1.18 times with our current assets. You can do the same thing for 2020. So for 2020, your current assets are 708, and you can divide that by the current liabilities in 2020, which is 540. When you'll do this math, this will give you 1.31, and again, the unit of measurement is going to be times. So that's it. That's one way that you can measure how liquid the business is. Is this good? Is this bad? Well, you can't really, so generally a number greater than 1 is comforting, right? As you can probably see. Why? Because for every $1 that we owe, we have more than $1 to cover it up. But that said, in order to reflect on this number, we need to, again, do some sort of a trend analysis in which we compare maybe 2020 with 19 and say, hey, you know what? It seems like we're becoming more liquid. Now, I'll talk about whether that's a good thing or not in just a minute. But the point is that you should be comparing this number with either some previous number in like a previous year, or maybe look at this number and say, hey, how are my competitors doing? Again, you must be doing either a trend analysis or some sort of peer analysis in order to reflect more on this number. Okay. Now, current ratio is one way in which you can measure liquidity. But then there's another one which says, look, within our current assets, we know these are our liquid assets. They're all going to translate into cash in 1 year or less. But some are going to do it better than others. Within current assets, some are more liquid than others. For example, cash and cash equivalents, that's practically cash, right? But inventory, this is going to take a little bit time, right? We're going to convert it into raw, a product, then a sale, finally cash. So it's going to take time. So what if we wanted to assess, how liquid we are, if we take away some of our less liquid assets? That's the idea behind quick ratio. Quick ratio says, let's take a look at current assets, but from all of that, let's subtract inventory, right? Because inventory can be less liquid than others. So how much are we left with after that? Well, you can do the same analysis for 2019 and 20. So for 2019, you'll say 642 is my total current assets. From that, I'll subtract inventory, which is 393, and then I'll look at this number in relation to the 543, which if you do the math comes out to 0.46, and again times, right? Again times. And here, same idea. You start with 708, but then you'll subtract the inventory, which is 422, and then you divide that by 540, which will give you 0.53 times. Okay, so again, look, don't say which one is which is the right one. No, there's no right one. These are just different ways of measuring the same thing, right? One is current ratio, look at all current assets. The other is saying, well, maybe let's be a little bit more conservative in our estimate and say, let's take inventory out. This is the least liquid, and then see how liquid are we. At the very least, you should calculate both of these. Why? Because at the very least, it will give you a sense for, how reliant you are on inventory in meeting your short-term obligations. So notice this ratio dropped from 1.18 times to 0.46. That's a huge drop. What does that tell you? That once you don't account for inventory, right, you have less than 50 cents for every $1 that you're going to owe. Right? Which means that you're heavily reliant on your inventory to translate into a sale so that you can pay your suppliers or your short-term debtors. Good thing or bad thing, that's a separate issue. But you wouldn't have been able to come to that conclusion unless you'd done something like this, right? So that's exactly the idea. So that's quick ratio. There's a ratio which is even more conservative. That's the cash ratio. Cash ratio says, look, forget about all current assets. Forget about it. Just look at one current asset, which is this guy, cash. If a supplier comes knocking on the door in the middle of the night and says, hey, where's my money? I need it right now. You can go to your customer and say, please give me, the money that you owe on the sale that I made you. So can't collect on accounts receivable, can't convert the inventory right away. So the question is, how well are you equipped to meet that current liability? So that's the cash ratio. It says 84 divided by 543, and here again you'll have 98 divided by 540, right? Same idea, and you can do this math. So different ways, and again times, different ways of measuring liquidity. Okay. Now, with all that said and done, there are a couple of things that I urge you to remember always whenever you are calculating liquidity ratios. The first is this. If your liquidity is increasing over time or is relatively high, which means that you look at your peers and you're doing better than them in terms of liquidity, your number is higher. You might be liquid. Whether that's a good thing or a bad thing is not Well, it depends. So increasing a relatively high liquidity is not necessarily a good thing, right? So in this case, we saw that liquidity was improving from 1.18 to 1.31, from 0.46 to 0.53. In fact, if you'll do this math, this will be 0.15 and this will be 0.18. So you might say, hey, great, my liquidity is improving. Is that good? Not necessarily. Why? Because increasing liquidity could mean that you have a lot of your assets tied up in short-term assets and therefore less money going into long-term assets. Short-term assets tend to be less profitable, right? If you have all your money sitting in a bank account, you have a lot of cash, you're very liquid, you can meet your short-term obligations rather quickly, but you're also not very profitable because you're not making a lot of long-term investments, right? So this will in turn get reflected in some other ratios, maybe profitability ratios, right? Don't look at a ratio in isolation. Don't look at liquidity in itself and say, hey, we're great, we're very liquid, great. One ratio generally tends to have implications for other ratios. We'll talk about them, right? But it's students tend to make this mistake a lot. Look at ratios in isolation. No, it's all connected, right? You have to tell the story, right? So don't focus on increasing liquidity and say past the conclusion, oh, this is good. Not necessarily, okay? And by the exact same token, decreasing liquidity is not necessarily a bad thing as well. One obvious reason for that is this: if your liquidity is going down, as we just said, it's possible that you're maybe investing more in long-term assets. That's one thing. But the other reason why decreasing liquidity is not necessarily a bad thing is because liquidity ratios, this is important, liquidity ratios don't give you a sense for your borrowing power. What do I mean by that? Let's suppose that your liquidity is going down, which means that there's some short-term debt that you owe, and your ability to meet those short-term obligations is going down, right? This, you might say, oh, that's bad, but what if you have the ability to go to your bank and get a short-term debt or maybe a long-term debt and use the funds from those to meet those upcoming short-term obligations to your suppliers? See, a liquidity ratio by itself does not capture your borrowing power, right? Your ability to borrow. Now, so what I mean by that is that therefore, a decreasing liquidity ratio therefore may not necessarily be a bad thing, because you do have the ability to meet those short-term obligations. It's just not from your current assets, but maybe another source of funding. Now, that said, if you do that, then eventually, your liquidity or your indebtedness may go up or your liquidity may go down, right? Because you're going to be borrowing. You're going to be meeting one liability with another. That's a separate issue. My point is, liquidity ratios don't capture your ability to borrow to meet those short-term obligations, which is why you should always not just focus on a ratio by itself, but try to zoom out and look at the bigger picture. So this is all that I wanted to say on liquidity ratios. In forthcoming videos, we're going to talk about some other ratios that you can calculate to assess the financial health of a company.